All right, guys, let's get started. Um, so today we're going to talk taxes. Super fun conversation. I know it's everybody's favorite, so we're going to go ahead and get into that. We'll recap a little bit of what we talked about last time too, just to make sure that we catch up any discussions about that in case we wanted to go over those things. So I'll just flash by some of those account types that we talked about. Remember your individuals and your individuals with your transfer on death. Um, if you don't have much of estate planning, go for those TODs, go for those PODs. Use that to get assets moved nice and quickly if you don't want to have to re-register stuff to trusts. We've got our different types of joint accounts. Just go ahead and check, since you're in California, if you are married and you've got any joint tenancy with rights of survivorship, start considering if it's worth re-registering towards a community property in order to get some of the better tax benefits. But just kind of understand where these things are. Obviously, we talked about those community property benefits, things like where the entire account gets stepped up upon a death of only one spouse. So that's really great. That's why we like to just look and see if anybody's got those joint tenancy with rights of survivorships. And if you got a spouse, really easy re-registration, and it's just an immediate benefit that you just don't really want to lose out on. So we just like to mention those a bunch. You've also got your trust accounts. So obviously, if you don't want to have an account transfer, you just want to register it to the name of a trust. That's something else you can do also. We see that a lot with brokerage accounts, checking accounts, all sorts of things. You could put things like real estate in your trusts as well. So that's another option also, to re-register things into the name of the trust and just let the directions take care of the assets as they sit in there. We've got those community property benefits that we talked about earlier that no other accounts get to enjoy, which is really nice. So again, just the third reminder today already, but if you got accounts that are worth transitioning over or re-registering, just take a look. Then we've got our couple types of trusts: revocable trusts and irrevocable trusts. We talked about what some of the benefits for each of those might be. Revocables are really nice, easy to set up, easy to modify. It's a great organization tool. So that's kind of one of the easy things to do, is to create the revocable trust and then put it as the beneficiary on all your different types of accounts. And that makes it a little bit easier than re-registering every single individual account one by one versus just changing a beneficiary designation. Then you've got your irrevocable trusts, where if you really want to get stuff out of your estate or get it protected from creditors or any other sorts of things like that, we like to see that used. Then we've got our estate planning checklist. So we'll just run through it really quickly. Make sure you make your inventory, account for all your needs, get your directives established with your power of attorneys, advanced medical directives and stuff like that. Check your beneficiaries. Always check your beneficiaries. Don't leave any beneficiary designations blank. Really, really important. Everything else could be accounted for, but if you've got blank beneficiary designations, it's not going to follow any directions. So just make sure you look. Check on the estate tax laws, especially for out-of-state relatives or anything else that's going on out there. And then just check and see if it's worthwhile to maybe get a little consultation and reassess your plan frequently. Okay, now we're going to get into the fun stuff. When it comes to tax efficiency management, we're going to talk about a couple of these things, how they're going to work. I'll talk about some different preferential tax rates, and we'll just try and go nice and slow through this because it can be kind of complicated. But let's just start talking about what we mean in the first place by tax efficiency management. So usually it's just looking at your different options, whether it comes to types of accounts, whether it comes to where you take withdrawal from, what types of investment products you're using. It's not a whole lot of these giant things where I give you a suggestion and now suddenly you're going to just save half your tax dollars. Like, let's keep our expectations a little bit in line. But there are things that we want to look at just to make sure that we're not throwing money away or giving interest-free loans to the government, because, you know, we don't really want to do that too often. But there's a couple things to consider. Well, I have these sort of main categories, and then we'll dive into them a little bit more individually. So we've got types of accounts and what sort of benefits each of them provide. This will probably be the stuff that you're most familiar with, because you'll think of your 401ks, your IRAs, your Roth accounts, HSAs, all that sort of stuff. You'll probably be most familiar with this section of all of these. So we'll go over those, but we don't need to spend too much time there, but we can review them anyway. And then we've also got types of investments. So based on all the things that we talked about when we talked about dividend paying stocks, when we talked about interest bearing securities, when we talked about growth securities, all of those also will have different tax ramifications inside of a taxable account. So we'll look a little bit more in depth about what that means on the basis for each of those, so we can understand where we might want to be placing things, which takes us right to the next thing, which is the location of those investments. So there are certain investments that are going to be more efficient in different places. So if we want to make sure we take the best advantage of our investments, if we have the ability and latitude to move things around and make sure that our allocations are structured in that type of way, there might be some tax benefits from holding certain investments in a Roth, certain investments in an IRA, certain investments in a brokerage account. Then, of course, we've got preferential tax rates. So we'll talk about each of the different types of tax rates that you might get taxed on different types of income or capital gains or all that sort of stuff. So we'll make sure that you're taking advantage of that, because there are some really preferential tax rates that we want to use. I'm sure you're familiar with long-term capital gains. Super great. It's much better for me to pay 15%, or if your income is low enough, 0% on capital gains versus 24% on short-term capital gains for the same, benefit of growth. So let's start with accounts. Now there's going to be a lot of stuff up here, and there's going to be more things that I haven't listed, but we'll have two main categories of different types of accounts, whether that comes to investment accounts or whatever else. But we're going to talk from the frame of investments, because that's where all of this is going to be spoken through. So we'll have tax advantaged accounts, which are accounts that come with a tax advantage. Pretty self-explanatory, but they provide some sort of tax benefit, and that can be either tax deferral or it can be tax exemption, which is really nice. So if you've got tax deferral, that's going to be stuff you're super familiar with, your traditional IRAs, traditional qualified plans like 401ks, 403bs, all that sort of stuff, where you get a deduction for the money you put into the account because you're deferring the taxes on that now, and then you're going to pay the same ordinary income taxes on the way out later. So if you're deferring taxes right now, you're going to pay that same non-preferential rate just later. So you're really just adding time in between. You're not really getting a preferential tax rate. You're just delaying the time between now and paying taxes. Usually that becomes most helpful when you have a high earning situation. So if you've got high income and you expect that you're going to retire and have less income, that's where some of the math shakes out really well, because you're going to skip the higher tax rates right now if you make, top tax bracket money. Then if you're going to be in anything lower than that, then you get to take your withdrawals at a lower tax rate. So that's pretty nice. So you get your traditional IRAs, which have much, much smaller contribution limits, like $7,000 right now. It's not a whole lot, versus qualified plans, which can have annual additions, meaning your deferrals plus employer deferrals of up to like $60,000. So really big difference in the contribution limits there. But obviously, those are most helpful for people that are currently earning and deferring. Then you've got your tax exempt accounts, which will have some, mixture of different types of things going on in them, but the things that we are the most familiar with, I think, are going to be your Roth accounts. So things like Roth IRAs, where you have that same contribution limit as a traditional IRA, except you don't get any tax deferral when you put it in. But the benefit of that is every single distribution following that, after you hit the required age and you're taking it for retirement and all that kind of stuff, you get tax-free withdrawals, which is just amazing. So Roth accounts really use that benefit of time super well, because if we're putting in, investments that get a lot of growth, or they get really, really high interest or ordinary dividends that would be really highly taxable right now, but we defer all of that, and then, or not defer it, but we defer the earnings on it, and then we don't pay anything on those distributions. That's pretty great. So that's why we like those for young people like in their 20s and 30s and maybe even 40s sometimes, doing conversions, because that time of growth, all that growth compounds, and then taxes never take away from it. So that's pretty fantastic. But obviously, you pay taxes on your money going in. And then you've got things like 529 plans, where you also, those are limited to your qualified expenses. So, things like 529 plans or HSA accounts, they're limited to specific things. But something that's interesting with the 529 plan that was in the Secure Act 2.0 was that I think it was, if you had the plan for like, what was it, 15 years or something ridiculous, then you could use some specific amount of it. What was it, $35,000? Okay, $35,000 that you could move that and into a Roth for the beneficiary. So that was kind of interesting, but a lot of really specific requirements for needing that. So it's not something we like to. Yeah, because that's what that 529 plan is. Yeah. Mhm. Right. Yeah, exactly. Yeah, so that would be your college savings plans. Then you've got your non-tax advantaged accounts, which is pretty much everything else. So every other account that you can think of, your individual, your joint community property, trust and estate accounts, all your custodial accounts, and then business and entity accounts. So you're getting after-tax dollars, and if you've got earnings or capital gains, it's taxed in the current year, and then you get to take those out. So a couple tax advantaged accounts we've got are tax deferred accounts. Like I mentioned, they enjoy their current tax deduction on the way in, and instead the IRS is collecting their share on the way out. So you're paying ordinary income tax on those distributions. Remember, we're talking about if you're deferring the taxes now, you're going to pay ordinary taxes later. So if you're escaping your ordinary tax now, you're not going to escape it later. But if you're not looking to get away from the ordinary income tax now with something like a Roth account, then you get to take those distributions tax-free with a couple qualifications, which is why I mentioned they're super, super, super valuable for young investors with super long time horizons, because they get all of that growth that ends up being tax-free. And if you're younger, you're usually not in a super high tax bracket, so it's low taxes going in, no taxes coming out after decades of strong growth in something like an S&P 500 index fund. I'll take that every day of the week. Really, really good. So you've also got tax advantaged investments. So there's a couple different things that you can do if you are holding investments in a taxable account. So let's just say we're talking about an individual brokerage, we're talking about a trust account, something that just gets no tax benefits. So we're not trying to do any, we're trying to get the best after-tax returns that we possibly can. So we've got tax managed funds, which usually is going to be something like an actively managed mutual fund where they do whatever it is they're doing, growth or value or whatever the strategy might be. But the idea is they're trying to do as much netting capital losses against capital gains inside the fund. And they're trying to be as concerned as possible about the taxes of the gains to the end investor. So a lot of if you've been in managed mutual funds before and they weren't tax managed, you might notice that they kick out a lot of capital gains to you. So if they make a lot of money and they sell their investments internally, they've got to pass that out to you, which is why a lot of times we might move from those mutual funds to ETFs if we don't like the current income tax. But there are tax managed funds out there that their whole point is going to try to be to reduce those tax liabilities as much as possible. And in doing so, you get a little bit of what we call tax alpha. So if we're actually able to mimic the performance of some kind of growth investment or index investment, but we're able to net some losses and gains against each other, because a little tiny bit of that return doesn't get lost to taxes, we actually get to consider that an extra little bit of return. Now, a lot of the time, in a straight bull market, that's hard to do because you don't get a lot of lost securities. And so if the market has this nice, wonderful, positive skew that we use to grow our investments, tax loss harvesting and all that kind of stuff, it's really beneficial for like 1 to 5 years, and then you stop getting the benefits because all of your positions sit at gains. So it's usually more of a short-term thing that's helpful, or if you got a lot of individual stocks, it can be great, but we'll talk about that a little bit later. So then, after we move from tax managed funds, we also just have the idea of the exchange traded fund. So the ETFs, just by their nature, by their structure, are more tax efficient than mutual funds. I believe we've had this conversation before, but we'll just run through it one more time because I think it's really cool to understand how this works, and it's confusing. I didn't understand it the first time, and I had to read it a couple times over. But essentially, with a mutual fund, that mutual fund buys and sells the investments inside of their accounts. It's like they hold a nice big trust account for all of the investors. They buy and sell their stocks. They buy and sell whatever it is that they're doing in there. And when they generate those capital gains, it goes right out to you. Now, the difference with an ETF is they work with a partner. They work with somebody called an authorized participant. So instead of buying and selling stocks and bonds themselves, they go out to this authorized participant and go, we made this ETF. We got a whole bunch of shares we're sitting on. Would you like to try and go sell those for us? We'll trade them with you for some stock that we want in our fund. So if this ETF wants to be a tech fund and they're missing Apple, they don't have any Apple yet, they'll go find an authorized participant and they'll go, hey, we'll give you a whole bunch of our shares, our ETF shares, if you'll trade with us for some Apple stock. And then that authorized participant will go get the best deal on Apple stock they can, trade for the ETF shares, and then they'll go hopefully sell the ETF shares at a little bit higher price, and they make that spread in between. So the ETF then effectively sees no sale, because it's kind of like a 1031 exchange where you're exchanging something that's like kind. It's the same sort of thing. So there's no sale going on. I'm just exchanging proportionate value of two different things. So I didn't sell anything, I'm maintaining the same thing, and the value just keeps kind of going up, and we just keep switching and switching and switching. No buys, no sells, and therefore no capital gains that get kicked out to our investors. So that's why exchange traded funds can be a lot more tax efficient when it comes to growth and capital gains. Now, obviously, if they're paying out dividends, those are still going to be taxable unless we're talking about municipal bonds or something like that. But following our exchange traded funds, then we talk about government notes and securities. So we're talking about treasury bills, treasury notes, treasury bonds. That one's pretty easy. They're super high quality debt and they're not taxable at the state level. So if you want something really easy, maybe your federal taxes are not ridiculously high, but you want to save a little bit on state taxes because I believe we're the third highest tax state in the country. So you might want to just use some treasury bills instead of municipal bonds or government bonds. So you can get the rates on treasury bills are still really nice. They're still, for some reason, they're not going anywhere. You know, we're still maintaining really high yields on short-term treasuries, especially with ETFs and stuff like that. So you can get really nice yields, not taxable at the state level. So that's a really, really easy switch or place to go if you want a little bit of tax advantage yield. Then, of course, you've got municipal bonds. So these are not taxable at the federal level, and they can be non-taxable at the state level, pretty much if they're from your home state. So if you go buy a fund of California municipal bonds, you're not paying any taxes on that income, and that's pretty great. But the thing that you want to make sure that you understand is that there's going to be a difference between the yield that's earned on a municipal bond versus what's earned on a taxable bond. And a lot of people will go, it's tax-free money, I don't really care, I'm going to save money because I'm not paying taxes on it. And while that might be true, you have to understand that you have to compare those two yields. If I get a 3% yield and on a tax-free municipal and a 6% yield on a corporate bond, my tax rate needs to effectively be 50% for that to be a worthwhile switch to do for the tax-free bond. So if my tax rate isn't that high, if I'm a regular person sitting at 24%, that ratio is not really super helpful. Now, obviously, you want to take in your state taxes to consider that, but you just want to make sure that those ratios are actually beneficial for you so that you are actually saving money and not simply losing money because you wanted tax-free yield. And now the other thing that is curious, I didn't know this until very recently, is that there's taxable municipal bonds. So you got to make sure that if you're buying munis, make sure you're buying a tax-free muni. Now, if you're buying ETFs and mutual funds, it should be pretty obvious. They'll say on there if it's a taxable fund, but there are some taxable municipal bonds, which I see sometimes in an IRA or something like that, and it always catches me off guard, and I go, why is there a municipal bond fund in this retirement account? And I have to remind myself, yes, there are actually taxable municipal bonds, which is interesting. So you might even consider the tax ramifications of growth versus value styles, or high dividend versus high growth styles. Now, obviously, if this is changing your risk tolerance, if this is changing the objectives of your portfolio, all that wonderful stuff, don't make changes just to save money on taxes if it gets you away from the goal. But the one thing that is good to understand is that growth investments are very rarely high dividend paying. Usually, and I think I've explained this a couple times before, but if you're looking for a company that has growth, the idea is that all of their income gets reinvested into market expansion. Market expansion, new products, all this other stuff, they're looking to expand their market share as much as possible and increase their market cap and all that wonderful stuff. Versus a value stock, usually they're either pretty well cemented in their market share or they're just not growing at such a rapid pace that they actually have net profits at the end of the year or at the end of the quarter or the end of the month, and they're sending them out to their shareholders via dividend distributions. So that means that those high dividend paying stocks, more of their overall returns, the total returns, will end up being dividends that come out to you, which is currently taxable. And you can have two different types of tax rates on dividends that we'll talk about later, but you can either be taxed at ordinary income tax rates, or you can be taxed at capital gains tax rates. And when it comes to funds, like value mutual funds or ETFs, it gets a little bit harder to know exactly when you're going to pay each different tax rate, because there's requirements both on you holding the ETF and the ETF holding the stocks inside. So we'll get to that a bit. But with the growth investments, more of their total return is just the increase in price. If you were to compare something like the S&P 500 versus, I don't know, Coca-Cola stock or something like that, that higher dividend over here is going to be a bigger percentage of that overall return. But on the S&P 500, because their dividend's only like 1 to 1.5% usually, more of that return of that 10% annual figure is just price increases, which doesn't give you any current tax liability. That's just building up until the sale. But again, remember, growth usually doesn't give you current taxable events. Value does, and that can be at a couple different tax rates that we'll get into in a second. So here's again basically the slide that's describing the exchange traded fund structure that I was talking about before, because ETFs, it's possible that they kick out capital gains, but they pretty much never do, because it's just, there's no point for them to do so if it's so much easier to just do a like-kind exchange with some sort of authorized participant out there, because it doesn't make a taxable event through the sale. So you're having more tax-efficient returns for your investors. Yes. So this is basically somebody, you can kind of think of it as, it's not the same thing at all, but you can kind of think, when you think of market maker and authorized participant, there's sort of groups of the same circles of essentially what they're doing is they're just people with giant oodles of money, and they help facilitate movement in the market. And they just help the creation of these products. So these authorized participants. Yeah, there are people that we will never interact with or really hear about. It's just kind of like, that's when you really get into Wall Street, that's these sort of people out there. So that's those bigger participants that are helping those ETFs get created so that we can then buy the end product. But again, that authorized participant, or AP, instead is the entity that buys and sells the ETF shares as well as the investments inside the fund. So the ETF is taking a little bit more of a passive role. They may have sold shares initially, but a lot of the times when they want to issue new shares, they'll simply issue shares to trade with an authorized participant to make changes in their portfolio or anything like that. And sometimes the authorized participant will just hold on to the ETF shares until the day that they want to redeem them back. And so then they'll go, okay, great, I want to trade back again. Are there any stocks you want to get rid of? And then they'll trade, and then they have that for their portfolio, and all these wonderful advanced things that happen there behind the scenes.
It's popular and people want to buy more of it. They have to go to the participant, authorized participant, say, give me some stocks and I'll create no more shares. So it's an in and out, keeps it consistent without going up front. Right?
Yeah, exactly. Yeah, and ETFs are, that's one thing that's also interesting is this isn't necessarily too much of a tax thing, but it is something that's interesting because mutual funds, you're essentially dealing directly with the fund company, and you're always buying at what's called net asset value or selling at net asset value, because they always recalculate that at the end of the day. It's a little different from an ETF because the ETF share is ever so slightly disconnected from the company. It's like how you can have a stock that trades at a ridiculously high valuation versus what they're doing in their business. ETFs can actually trade at slight premiums and discounts relative to the value of what they've got in their fund. So you can have this little teeny tiny bit of premium or discount based on how popular or unpopular it is, or whatever sentiment there might be going forward. So that's an interesting little structural difference between those two. But again, those exchange traded funds, they end up being way more tax efficient for the end customer because of that. You don't pay those gains year after year. Now, if you've got the money to pay for the tax bill, it's not really that big of a deal. Or if you're willing to, make those estimated payments or whatever the case may be, because you're just essentially going to be increasing your basis every time you get a distribution. That money that you get taxed on, if it's reinvested, it just adds to the basis. So instead of, if you get paid out a distribution for a decent chunk of it, that'll then raise the amount, and then, you don't pay taxes on that later. You'll still have all that gain on top of that, but because they paid out that capital gains to you, that's not going to be taxed at a later date. So it means at the end sale, less taxable gain, but it does mean more taxable gain year to year. So this will, again, give you a situation where it's more tax efficient for beneficiaries. Because if you can defer all of those taxes in something like an ETF for growth, and it just keeps going and going, you're not paying taxes on any of those gains, and then somebody inherits it with a full step-up in basis, we didn't have to worry about any of those capital gains along the way. And that becomes more tax efficient, and we lose less returns to taxes year over year. So location of investment can be important too. So it's important to understand how the location of certain types of investments can affect tax efficiency too. So dividends or interest that are taxed at ordinary income rates might be better off in tax-deferred or tax-exempt accounts if the income's not needed for distributions and current tax liability is a concern. So if I'm looking at dividends that get paid out and they're taxed at ordinary rates, I'm not getting anything preferential, and I'm just basically getting taxed the same as my income, it might be nicer for me to defer that gain or defer that income to a later date, or possibly get it completely tax-free. So same thing with things like high yield corporate bonds or corporate bonds in general. Because they're taxed at ordinary income rates, it might be worth considering if there's a more tax efficient location. Now, if we're using them for, if we've just got one big taxable account and I'm using them for adjusting risk and getting a little bit of yield and the tax rates are not that much of a concern, this is not like the biggest deal in the world. You don't have to go searching and be like, oh my God, I have high grade corporate bonds in my individual brokerage account. This is a nightmare. Like, you don't have to worry that much about it. But it's possible that you can increase a little bit of efficiency. And for the same reason, mutual funds might also be better suited for those same account types. Because if you've got that mutual fund in something like a tax-deferred account, IRA, or a 401k, you don't have to pay taxes on that distribution when it comes. You'll just pay taxes as you withdraw funds from the account. Now, obviously, that's going to be your ordinary income tax rates. That's not incredibly tax efficient at the end of the day, but if your tax rates are lower then than they are now, that might be helpful. But if you're comfortable paying taxes via excess income, savings, or through investment distributions, holding mutual funds that distribute those long-term capital gains, or if they distribute qualified dividend income in taxable accounts, might totally be suitable, as that income enjoys preferential tax rates. Because if you get that 15%, or if your income's low enough, 0% capital gains rate, that's pretty fantastic. Even at the absolute highest rates, the highest rate that you'll ever pay on qualified dividend income or long-term capital gains is 23.8%. And if you're paying 37 or 40% total on earned income, that can still be pretty attractive. So make sure you consult the IRS website and your tax professional for detailed help understanding your tax forms, because we're not tax planners, we're not CPAs. I'm just trying to give you some of the general advice and, direction that you might want to go. But if you might receive some or all of these 1099 forms. So you might get a consolidated 1099. That's what I get from Schwab. You might get a 1099 div, which shows your dividends, ordinary dividends and capital gains distributions for the year. You might get a 1099-B, which will be your sales and such like that. You might get a 1099-INT, which will be your interest, taxable and otherwise. And you might get a 1099-MISC, which will just kind of tie everything else together. So make sure you look through these to figure out how much you're paying taxes on ordinary dividends. So those are your dividends that don't get any preferential tax rates. So just check and see if that's still suitable for you. Check and see what types of capital gains distributions you're seeing. So if I'm holding on to a legacy position, like a really big mutual fund position, we might see really big capital gains distributions. But then at the same time, you got to weigh the tax liability of that versus the tax liability of selling the entire position and realizing all of the capital gains anyway. So those are just a couple things to remember. Make sure those will be your forms if you're ever worried about your taxes. Take a look at those and just always consult with your tax professional to understand those. And the IRS website also has really, really great explainers on a lot of those things. So investment gains, we've got some preferential tax rates, and investment gains and income can fall under various tax rates. So it's important to understand how each of these are going to fit into your plan as a whole. So we've got pretty much our two categories that we're looking at, which will be ordinary income taxes as well as tax preferred sort of tax rates. So in our ordinary income, this is the stuff you're familiar with. This is the stuff that you'll pay on W-2 income, that you'll pay on pension income, any of that sort of stuff. And it's exactly what it sounds like. Anything here gets taxed at your ordinary income tax rate. So we're talking about ordinary dividends. So these would be dividends from stocks that haven't been held for very long, non-governmental bond interest income. So pretty much everything that's not a municipality or a treasury, fully taxable at ordinary income rates. And then you'll also have your short-term capital gains. So if you've held a stock or a mutual fund or anything for 365 days or less, not less than 365 days, 365 days or less, you'll get taxed at your ordinary income tax rates. So you always want to make sure that you hold it for that year and 1 day before you sell if you want to take advantage of preferred tax rates. So then we get to our tax preferred rates. So this is a more favorable category that gets taxed at either 0, 15, or 20% based on what level your income is. So it's a little interesting because it's not quite fully matched with ordinary income tax rates. The brackets are slightly different, and your ordinary income plus your investment income gets added up and puts you in this other bracket for capital gains, and it can be a little bit confusing, but essentially you either get taxed at nothing, 15%, or 20%. Then if you've got really, really high income overall, you might get an additional 3.8% net investment income tax, which is there. So you've got two different things that usually fall into there, which will be your qualified dividend income and long-term capital gains. Now, I forget exactly what the definition is for qualified dividend income when it comes to fund. Let's see, I actually want to see this. Qualified dividend income. But essentially what has to happen is you have to hold a stock for a certain period within a certain set of days. So it's like, I think it was like 60 days in 100. Yeah, so a dividend is considered qualified if the shareholder has held a stock for more than 60 days in the 121-day period that began 60 days before the ex-dividend date. So before the ex-dividend date is basically, that's the date before which you have to buy a stock to get the dividend. There's like a little period of time where if you buy it right before the dividend gets paid out, you're not going to get it, and the previous shareholder will. But for stocks, you have that 60 of 121 days. But then if you look at ETFs or mutual funds, they have to follow that. So they have to have held the stock for 60 out of 121 days. And you have to have held the fund or ETF for 60 out of 121 days. So it doubles up on each other, which can be a little bit annoying, but assuming that the ETF is like an index value fund or high dividend fund that's not trading in and out all of the time, most of their dividends should hopefully fall into that if they haven't been acquired in a super short period of time. So that can be kind of helpful to get us a little bit of preferential tax income without having to go straight to municipals. Yes.
This is a question from Zoom, just to be clear. So do the value ETFs have capital gains?
Okay, so when it comes to capital gains, you're not going to see capital gains distributions because ETFs often don't distribute those capital gains. But if the value of the ETF increases, that gain from where you bought it to where you sold it, you're still going to have to pay capital gains. So just because it's value and dividend focused doesn't mean that it won't ever go up in value. And when it does go up in value, you will owe capital gains on the difference between your purchase and sale price. So, yeah, when you sell. So dealing with gain positions, there's a couple things that you can do if you're sitting on really big gain positions, whether it's stocks, ETFs, mutual funds, whatever the case may be. So if you're totally committed to selling out of this position, consider exploring the specific shares method for ETFs or last in, first out. So what I mean by this is when you go to sell positions, you can actually direct your broker-dealer which shares or which lots you can sell from, and that can help get you a little bit of preferential taxes. Now, obviously, if you sell the ones that had the least gain, Later, when you sell the rest, you're going to sell the ones that have the most gain, so you want to prepare for that. But oftentimes, what is the automatic choice for sales is what's called last in, first out. So whatever you bought the latest, whichever was the last share that went into your collection of shares, will be the first one that sold or the first one that comes out. With a market that is pretty much always bullish, or if we're in a really big bull run, that's going to be your best bet, because always the last one that you bought is going to be the one that you bought at the highest price most of the time. But let's say that you bought something at a really high price and then it fell, or whatever the case may be, and then you have all these gains on the recently purchased positions, but your first ones are held at a price that's pretty much mimicking the current price. You could go first in, first out, so the first shares that you bought at the high price are the first ones that you sell. But you can also tell your broker-dealer, say, sell this share, and this share, and then you can get a really, really strong tax-efficient sale out of your position if you've got different gains on different shares. Now, if you're not ready to sell, and I see this a lot of the times when we got people who are really, really tied to individual stock positions. Most common example I see is Tesla, where it's just people have bought in their Tesla, they saw it get 1,000% gain, and now they're down to 400% or whatever the case may be, and they're wanting to hold on to it, and they don't want to sell, or they want to just keep buying more. You might then just consider allocating around that gain position in order to maintain your proper balance. So if I had a situation where I had maybe 30 or 40% of my account balance in Tesla, let's assuming that I want to stay all equities, I don't need any bonds, I might start buying some sector funds around that, or value funds, or just things that don't share the exact same qualities of that individual stock. So I wouldn't want to get super overweighted on more S&P for all the tech exposure. I wouldn't want a lot of tech funds in specific. I would just want to make sure that I get a lot of defensive categories or value categories, cyclicals, all the other types of stuff to get around that and create a nice balanced approach, even maintaining that single stock, and just kind of treat that single stock like a tech fund.
Question, if I have one big stock and I don't want to sell to the capital gains
Mm-hmm.
and I build around it, but I do want to insure it, how is that going to eat up my money trying to buy what puts and other little things?
Yeah, so anything that you do to try and get downside protection is going to cost money. So if you want to go, well, it depends, because derivative contracts are complicated, to say the least. You have a lot of different types of values. So what he's getting at is the idea of using an option contract in order to protect a single stock position. So if you got an option contract, you've got two different basic types. You got your calls, which if you buy a call option, you're buying the option, but not the obligation to buy a stock at a set price. That could be above market value, below market value, at market value. If it's above the market value, it'll be cheaper because you're paying for the option to pay more for the stock than it's currently worth. And then if you go under the stock price, same thing with a put, which is the opposite. You buy the option, but not the obligation to sell the stock at a certain price. So if you wanted to protect a single stock position, you might have a stock that is sitting at $100 and you don't want to sell it for anything less than, I don't know, 90 bucks. And you might purchase a put that gives you the option to sell your stocks at that price if things swing under that price. Like if the stock drops to 80 or 70 or $60, then you exercise that option and you get to sell your stock. Now, the problem is you can't ever guess when you're going to need to exercise that. You can't ever know for certain when that's going to happen, or if it's going to be profitable or just protecting a loss. And every time you go and purchase a contract like that, one, it has a specific time frame that it remains in effect for, so it can expire and then you just can't use it anymore. Or it could be really expensive and eat away at the cash that you use to purchase to it. So
Use it just, let's say I'm going to retire in a few years, my income will be lower. Maybe buy the put option to protect it, so then I can start selling it off in a couple of years.
yeah, possibly you could do something like that. Yeah, yeah, you could do something like that for sure.
Do they get expensive, like 1% of the value of the stock, or half of it?
Oh, they definitely get super expensive, because what you're doing is each option contract gives you, it basically gives you the option over not just one share, but over 100 shares. So it's like, it gets to be a pretty big amount of control that you buy with that option. And you've got two different things that determine the price. You've got intrinsic value, which is pretty much the difference between the price of it and the price of the stock. So if you buy the put above market price, and then if you're $10 above, that contract will cost $10, but you also have to have the value of the sentiment of the market of where it's going, because when like implied volatility is basically the idea of like how much do we think this is going to move at any point in time, and that gets priced into options like that within seconds. It's going to cost you an arm and a leg. Yeah. And so that's why generally it can be pretty expensive, especially if you're doing really strong protection. Now, if you're just saying like all the way down there is where I don't want to be. If you've got tons of gains and all you want to not give up is, you know, your position, like your, if you are willing to give up gains, but you don't want to have a loss, that usually will be a lot cheaper if you're sitting on tons of gains. But if you want to maintain the gains, you're going to have to buy the contract, it'll expire, you buy it again, it'll expire, you buy it again, until finally it gets exercised. And then even then, you're just protecting the position, selling it, and then still paying capital gains on all of those gains. So yeah, exactly. Yeah, pretty much anything, advanced strategies like that end up being expensive, inefficient if you don't really know what you're doing. So exactly. Yeah. And so I guess one of the things that could be more beneficial for that is if, say, you're sitting in a position like a single stock and you're pretty happy with where it's at. You're not really needing it to go up a crazy amount. You want to protect its downside. So what you might do is, you know, you could purchase some protective puts on the bottom, but then you could also sell some call options. So you could sell somebody else the option to buy your stock and say, I'm going to sell you this for a little bit of premium. If it goes way past that, they're going to exercise it and buy your stock from you. But you got a little bit of premium during the time, and you get the gains, and you get to get out at a nice price. And then you can also use some of that premium. If it goes down and you exercise your put option, some of that call option premium can offset what you spent on the puts.
Is that called there's some kind of balance? I can't remember what say it in movies all the time.
Yeah, but there's a lot of sort of complex stuff that you can do with options and stuff like that to protect.
Is that a call?
So a caller, that's buying one on either side, right? I think. I'm pretty sure, I don't remember. Anyway, there's the collars, there's iron condors, there's butterflies, there's all sorts of different stuff that I don't remember what any of that is called. Pretty sure the collar is buying one on either side because you're looking for like a volatility spike either way, and then that's how you can profit from either swing. Anyway, a little bit off track, but yes, those are some strategies that you can use if you're sitting on big individual stock positions. And the most volatile stocks, those options are going to be super expensive. So if you got something that swings up and down, Tesla puts and calls probably going to cost you a lot. But if you've got like a dividend stock, it's not going to be very much. Yeah. Okay. So next we get to tax loss harvesting. Tax loss harvesting. So tax loss harvesting can be a beneficial thing, but oftentimes I see people chasing it just to save tax dollars, and then they are like moving around to different asset classes, handicapping their returns, going in different directions, and then just like the average numbers don't end up shaking out for them in a way that's actually mathematically beneficial. But let's go through it anyway. So tax loss harvesting is essentially all you're doing is you're saying, I made some money through the year, or I want to sell some gain positions. I've also got some stuff that's at a loss. So I'm going to try and evenly offset each of those because losses offset gains. So you might sell something that's at a loss, sell something else that's at a gain, and then effectively pay no capital gains tax because there wasn't a real realized gain at the end of the day. It's most beneficial when you're dealing with short-term capital gains because if we kind of think back to those preferential tax rates, short-term capital gains get taxed at ordinary income. So if you were already going to sell something that you've only held for a couple months, maybe you bought Tesla at exactly the right time and it had one of those giant spikes to the upside, then you might consider tax loss harvesting if you've got short-term capital gains. If you've got long-term capital gains, sure, it can be beneficial if you really don't want the tax bill, but those efficient taxes, you know, those preferential tax rates are pretty good already. If you're looking to replace something that hasn't performed well with a cheaper, higher quality fund, this is a great time to harvest losses to offset gains on other positions. And I want to make sure that I emphasize what I mean by replacing with a higher quality fund. We're not return chasing. We're not chasing any sort of particular thing. We're just looking, if I've got a super heavily managed growth fund, and all of growth just falls to the floor right now, and I've been paying 0.5% or 60 basis points or 1% for this fund manager to manage it, and the returns are vaguely similar to a super cheap index fund, that's a great opportunity for me to take that loss, realize it, harvest it to use against gains later, and then buy a super cheap index fund. And then all the fees that I saved from paying that manager and getting the same performance will just go right back into my return. Because if you've got something like a fund that charges you 1% every single year, I mean, that just comes straight out of your return. So if they return 8% and the S&P does 8%, you got 7 versus the S&P got 8. So it's just a really easy switch to do. If you're getting similar to benchmark returns, it's just not worth paying those fees, and it's an easy switch over to a cheap index fund to get the same thing on the way back up. Capturing all of your losses all of the time is not necessarily beneficial. Because again, we don't want to handicap stocks before they get a chance to go. We don't want to just get rid of our sector funds because they happen to do poorly for the last little while, because now you're just going to be like, I bought in, I felt the losses, and then I moved to something else that now is going up, and then I buy that and I feel the losses again, and then you buy high and sell low constantly. So you want to make sure that you're not doing it just to get rid of every single red position. Losses are okay. They happen. If they're beneficial and you can make a change that doesn't change the strategy of your investment, that doesn't change the balance of your portfolio, that's totally fine. But don't just assume that every loser loses forever, because oftentimes they don't, especially if we're dealing with diversified investments, high quality funds, and ETFs that follow good indexes. It's really not super likely for every single thing that goes down in value to go down in value for the rest of time. Now, portfolio rebalancing and allocation adjustments. So rebalancing is something that we want to do because we want to make sure that we stay within our risk tolerance and our objectives. We know that, we understand that, fantastic. But you want to make sure that if you've got something like a taxable account, a non-qualified portfolio like a trust account or an individual account, maybe you should check and see if your professional is doing tons of rebalancing and trades that generate capital gains that you're not prepared for. You might need to rethink that a little bit. You might want to think about that relationship, because it's not about the fact that he generated gains. It's not about the rebalancing. It's about the communication about your situation that you're looking for. You don't want to be in a situation where you're really tax sensitive, your financial professional completely ignores that and then distributes tons of capital gains, and you don't have any money to pay for it, and you don't really think about taking distributions, and there's no communication there. We want good communication so that if there's taxes, we know that there's taxes and we're cool with it. We don't want to just end up in a situation where they're just going, oh, look at this really over concentrated single stock position. Let me just get rid of that. And now you get like, $5,000, $10,000, $15,000 of capital gains taxes sent out to you. So we just want to make sure that the relationship is operating in the way that is helpful and is not something that's hampering you on a day-to-day basis. Automatic rebalancing, so where it's just the algorithm that just trades it, or whatever the case may be, just following a rebalancing schedule to the T every single time without any thought, is not really suitable for the most part for a tax concerned investor with a non-qualified account. If we're just basically just a non-tax advantaged account, an account where if you make a sale for capital gains, you owe the taxes this year, versus an IRA where if you sell a position in there, nothing happens to your tax bill. So yeah, so IRAs, 401ks, 403bs, anything where the taxes are deferred until withdrawal. Yeah, we just think about those qualified accounts. It's
Like the qualified for a deduction or it does not. So non-qualified would not, did qualify for a deduction.
exactly. So again, that automatic rebalancing, not great. We can do conscious rebalancing and make sure that we stay within our parameters, we stay within our risk tolerance, and that's all great. But if we're just automatically doing it to keep everything with like the perfect percentage ratio, that's usually not going to be what you want for taxable accounts. You want something a little bit more dynamic, a little bit more relaxed, a little bit more of a soft rebalance every single quarter or year or whatever the schedule looks like. So when you're choosing new positions, if you're doing a rebalance, if you're saying, okay, it's time to sell out a bit of this growth and buy something else, you want to be aware of their characteristics. You want to know what happens with this, what are the tax liabilities on this new position. Are we buying a mutual fund that's going to kick out a bunch of capital gains distributions? If we are, and you're okay with that, fine. Is there a dividend? Is it likely going to be a qualified dividend? Because if it's an actively traded dividend fund, they might not ever be qualified. They might always be ordinary. If it's a passive dividend fund, they might be more qualified. Is the income tax advantage, like I just mentioned with the qualified dividends, or are they municipal bonds or treasury bonds? Do we know what the tax consequences of the income is going to be? That's what we want to know. So you just want to make sure that when you're making decisions, just be aware of it. You can make a decision that's not perfectly tax efficient. All of these things, they're just ways to just eke out teeny little percentages across the board and not throw away returns unnecessarily. But it's not like the biggest deal if you get some ordinary income versus some qualified income. It's not going to destroy your plan. The math will usually be pretty close to work out. So now that we've kind of talked about all of this, this is something that we have that is really just a step up to super tax efficient investing if you wanted to start from the bottom and work all the way up. So you might start with something like, so pretty much these are steps listed in order of importance, and you use the funds at the bottom first and then build from there as your dollars to invest and your experience grows. So not listed here is actually one of the most tax efficient vehicles, which is the health savings account, or HSA, which is not available to everybody. It's available to people who have earned income and for people who have high deductible health insurance plans. So if you're able to make a contribution into there, you can get a tax deferral going in, and then you can spend it on a qualified expense and have tax exemption coming out. Quite literally the most tax efficient vehicle I've ever heard of. You pay no taxes ever. That's pretty awesome. So with this sort of ladder that we've got, or this the stairway that we've got going on, you might start with tax favored money market funds, things like municipal money market funds, tax managed money market funds, moving up, and usually you put like emergency funds or just liquid cash in there. You might move up to tax favored index or ETF funds, ETF income funds. So we're talking about those municipal bonds, tax exempt income, stuff like that. Then you might get to the tax managed growth fund like we talked about earlier. Or you might think about index mutual funds or index ETF funds that are focused on growth that, again, probably not going to shoot out lots of capital gains distributions in the mutual fund side, and then also are not going to shoot out any on the ETF side and no dividends, so we're pretty tax advantaged there. Then we get to our tax deductible retirement accounts, so you can get that tax deduction going in, save the money now, defer the taxes until distribution later. Then, of course, personal residence is actually a pretty tax efficient vehicle as well, because you get basically all those gains in the property tax deferred because it's a capital gain, and then also if you have a mortgage, decent amount of that mortgage interest can be written off as an itemized deduction, which is pretty great. So I think we have a slide on that later, but it's all of the interest on the mortgage of acquiring a home up to $750,000. All of that mortgage interest is deductible. So that's pretty great too. And then you can put your improvements in there and all sorts of things, and you can get some nice growth with the real estate market. Then you've got your Roth IRAs, your Roth 401ks, Roth tax sheltered annuities, all those sorts of things where you don't get the deferral going in, but you get the exemption on the way out. And that's pretty fantastic as well. Again, if you've got lots of time, Roth accounts are fantastic. If there's only a couple years between when you're going to put the money in and when you're going to take it out, it's not super, super beneficial because you don't have a lot of time for compounding and growth, which is where the benefits actually come from. But if you expect your tax rate to go up in retirement, it could be kind of nice. Then, of course, you've got your tax deferred annuities. Make sure you stick in towards the no load ones or just super low cost ones, super simple stuff. We don't like buying tons of riders and all of these attachments onto these annuities because the fees end up being pretty high, and it just comes out of the dollars that you put into the policy. So one thing that's kind of nice about these, usually for the higher income earners, we're not usually looking at them for just any regular person because you can get a lot of tax deferral from tax deductible retirement accounts or Roth accounts. But with a tax deferred annuity, you put taxable dollars in, and then unless it's like a 403B or something like that, that's a little different. But if we're just talking about like a regular old annuity outside of an account, you're putting your tax dollars in, you're paying for the policy, and then the growth in there is deferred until you start taking distributions out or you annuitize, in which case a part of those annuity payments will be principal and some of them will be earnings. So it'll be kind of a half and half, not quite that ratio, but part of it will be taxable, part of it will not. And then you've got things like commercial real estate and personal business, which if you are active in things like that, you can get a lot of really good tax benefits. Obviously, your personal business, all the personal business expenses are tax deductible, so that's pretty fantastic. And then if you're able to earn money on that later, you could do some structuring to get some good tax advantaged growth and earnings out of that. So that's kind of a cool thing. These are good things to follow for younger investors too. If they just really like the idea of being tax efficient all the way up, pretty good thing to follow. So next, we're going to talk about Roth conversions. Roth conversions can be a hot topic a lot of the time. A lot of people like talking about these. A lot of people like rushing to do them. But there are a couple reasons why you might consider doing it and a couple reasons why you might consider not doing it, because it's not always going to be mathematically the best decision for you. So if you retired already and you're sitting in a lower tax bracket than you were when you made the contributions, so if you were at peak earning age and you were making a whole bunch of money and now you're on a lower fixed income or something, or you're living on distributions, you might be able to do a conversion and pay taxes on a lesser rate than you would have if you did a Roth contribution back then. So you've got the deduction from the higher income tax rates, and then here, now when you're in a lower tax rate, you do the conversion, you pay less taxes, and now it gets to sit in an account that doesn't have any required distributions, and you can let it grow for as long as you want. So that's kind of nice. Maybe you retired a little bit later in the year, maybe it's in Q3 and you still got a little bit of time until the next year, and you can maybe defer some of your current income, deferred comp, or some kind of pension that they're ready to pay you until the next tax year. And then you have this little gap of income for the last few months of the year, and you go, you know what? I can fill that up with what I expected to earn with a Roth conversion, and then you can move that over to the next account and defer that out and then take those distributions tax-free later. The other benefit might be if you just feel like giving the gift of paying the taxes to a beneficiary. So if you like the idea of leaving tax-free assets and you want to get them out of an IRA, you might go, you know what, let's go ahead and just pay for the taxes right now, and I'll let my beneficiary get all the money tax-free. Mathematically, it may or may not be the best thing, but sometimes people just want to leave assets that have very little hassle to them. And Roth accounts, because they're completely tax-free, pretty little hassle because there's no tax planning to do there, because it's just, here you go, no taxes on this income. Reasons, also if your future income is expected to be higher, or you expect your tax rates to continue to go up, that would be another reason to convert. If you're expecting your tax rate today to be decently lower than what you're expecting in the future, then you can pay the current tax rate and then let it keep growing and then pay no taxes at a later date. So a couple reasons why you might consider not converting to that Roth IRA is if that tax liability is going to move you up to a higher tax bracket. Because you got to understand, all of that's going to get taxed at your ordinary income tax rates. It's like taking a distribution out of your IRA. It gets taxed because you got to pay the taxes today in order to get the tax exemption later. So if this is going to kick you up to a really high tax bracket, that may not be something you want. Now, something that I don't have listed here, which is another thing you want to consider, is Medicare premiums. Medicare premiums will get affected by pretty much all kinds of income that you see on your tax return during the year. And that can bump you up by a couple $100 a month in premiums. And if that's not something you really want to have, you got to look at the different steps between the different premium amounts and see, where am I willing to go and where do I want to make sure I don't push myself into. Because once you trigger that higher premium, they look back for a year or two. So you get stuck in that new premium, not just for the year that you did the conversion, but for that year and the next year, and sometimes even the next year, depending on how long it takes for them to reset your premiums back. So make sure you're taking a look at that. Got a question?
Medicare, that going from a Roth,
Yes.
does that trigger Medicare
No, I don't think so. No, right? No. Yeah, because that's not going to be considered taxable income that would increase that.
If I have a Roth, I don't have to pay tax on it. I don't have to pull money out of it. If I leave it to a beneficiary, do they have the RMDs required?
They don't have RMDs, but there is a required distribution schedule, right? Like,
Yeah.
was it 10 years?
I think-
I always forget these time frames. There's so many of them.
If you
Yeah.
leave it off to somebody else, they don't pay tax, so they just have to have the money out of the account. I'm guessing in 10 years, like the IRA, in which you do.
But it doesn't trigger your Medicare full fund, non-taxable.
Right.
Yeah, don't think so.
Yeah, I don't think so either.
That we can convert to a Roth.
I don't, a maximum. I don't think so.
There might be, and you might Google it or something. I'm suspecting it could be 100,000 a year, but maybe they changed that. So, you'll be able to check it real quick. So,
I don't see any limits on the size of the Roth conversion.
okay, and obviously you wouldn't want to do a huge one or it would raise you to the highest tax level. So maybe that's why they don't put that there. They'd like you to pull that out.
Yeah, exactly. So the other thing would be if you don't, okay, this is an important one. If you don't have the money for the taxes set aside, because Roth conversion sounds great, but you got to understand that you need extra money in your pocket to pay for the tax liability, because every single dollar that comes out of your traditional IRA needs to go to the Roth IRA. You can't say withhold some of it and pay the taxes with that. All of it needs to go over, and then you got to pay the taxes out of pocket. So you got to make sure that you're ready to do that. Otherwise, it's going to end up being a distribution and you don't get to keep it. You don't get to put it in the Roth account. Like if you don't have any earnings and then you don't immediately move it over and you don't, you just put a little bit in there, it's not going to be considered a conversion. And then it's going to be a contribution that you're not actually allowed to make. Yes.
You're saying that you're gonna pay taxes on your, you have a regular IRA, you're going to convert to Roth IRA, you're gonna pay taxes on all of that IRA, gain, or no, on everything. But why would that be different than just cashing out or taking something out of it?
Because the idea is that you're not taking the money to spend. You're now putting it in the Roth IRA, and now any subsequent earnings beyond the conversion are tax-free. So if it grows further in value, all of that is tax-free. That's the benefit.
You could literally pull out 150%, pay the taxes, and then convert the other part, but it would wipe you out quickly. You would pay a lot more in taxes. So whatever amount you want to get transferred over, it's good to have the money on the side. But if you don't, you're gonna have to pull out 130% in order to pay the taxes to let that land into the Roth. Is that correct?
I was under the impression that you had to put all the money from
Yeah, put it all in.
because it's like a rollover, right?
Yeah.
Where all that money has to go. Otherwise, it's a distribution,
If that's the.
as far as I know.
Then roll it all over and then you pay the tax. But, if you didn't have to, and you could pull the taxes, you'd have to pull out 150% and lose 50 of it to taxes, but Nash may be right, you just aren't allowed to do that. You gotta pay the taxes out of pocket.
Yeah.
Okay, so you're. You have it all in ETFs and you roll it over and you keep those ETFs. They go right into the Roth.
Yes. Yeah.
You're not cashing them out, you're not selling them. You're just rolling them over.
Yes,
In
I
kind
believe
of
so.
exchange.
Yeah,
I think you can, yeah.
I think so.
It's some work. But I'm assuming that you can because you do them in kind and you're still gonna owe the tax outside of
I
that.
understand about the taxes, but I'm just saying, you're not cashing it out and then putting it, reinvesting it in the Roth IRA. You're just taking all your assets, your stocks and bonds, and you're just putting them in a different place. But paying the taxes on all of that.
My first guess is
Value.
you can do a like-kind exchange, like a rollover type thing from a pension plan. Sometimes you can transfer funds from rollover. But we'll have to wait and see if he can.
Yeah, I believe you can do that. Yes. Right. Exactly. Yeah, exactly. Yeah. Yeah, that's a great point.
And like Nash said, plan it before you take social security, you don't wanna do it.
Like,
They look back 2 years, right? So you wanna do it 2 years before you take social security at that point. And trivia, you can actually write off a Roth contribution. If it dropped a lot, you cashed out, there's some little quirk in there.
Yeah, it's if the value of the Roth is lower than the contribution initially, it has to be at a net loss from the contribution you put in, because you can always take principal back out. It's like if you lose money by taking that principal back out, that's when you get a deduction. Yeah.
I have a CPA.
Yeah, always talk to a CPA. Yeah, we're just here for guidance. Always consult with a tax professional because they're going to have the best detailed information. I could make mistakes on stuff like this. I'm always trying to make sure that we're up on it, but they're professionals at tax for a reason. So I always like to defer to their judgment.
Because they make mistakes.
Yeah, they sure do.
before R&D, and then you pay the tax on that,
Mhm.
and then you take that money and you put it in the brokerage, invest it in the brokerage account.
Yeah.
Separate.
Yeah, no worries.
While you do that brokerage account will continue to grow.
Well, absolutely, but not tax-free.
Not
Yeah.
Yeah.
Then for your beneficiary, that person will.
They get a
keep
step
it.
up,
They don't
exactly.
have To.
Right, exactly.
They don't have to take it out. for a certain
Absolutely.
amount of time.
Exactly. Yeah, totally. Yeah. Okay. And one more reason you might not convert to a Roth IRA is because your tax rates are not less than what they were when you contributed to the previous plan. If you're already going to be in a situation where you're going to pay the same taxes anyway, unless you just really, really hate RMDs and you want to keep them in a Roth IRA and not have to take them out, you're going to pay the same taxes coming out anyway, so the movement is just kind of a moot point. So, I mean, again, the main times that Roth IRAs, whether it's conversions or contributions work, it's when you have time for returns to compound and for that tax-free growth to start outweighing any of the other costs that it takes to make that move or that contribution, yes.
The IRS realize maybe you're not paying this many taxes for the year, we have the
Right.
No, it's not the last quarter of the year, so.
Yeah, you have to be, you definitely have to be very particular about that and make sure you tell the IRS exactly what you're doing. Otherwise, they'll assume, oh, you just had this income for the year and you didn't pay your estimates. What's going on here? So, just make sure you're planning that out and that if you need to pay some estimates in advance that you do that. Yes. Right.
For over. Every 20 years.
Mhm.
And then, so your contribution rates are different. That's where I'm confused when you say your tax rates.
Right. So
It's different.
possibly, but maybe not. You might have enough retirement income going on. You might have pensions or you might have Social Security, whatever the case may be. You might just be earning income at a different place than that employer, whatever the case may be. But if your tax rates are level or higher, I mean, you're going to be paying the same tax rate that you would have had without the deduction in the first place. So it's just kind of like, it's the same tax rate. It's not doing a whole lot for you to do that conversion unless you have tons of time for that growth to continue and compound. So really, it's kind of like add an asterisk to that is like if your tax rates aren't less than what they were when you contributed to the plan and you expect to use the distributions in a short time frame and you're not going to lock them up for another decade or two. So really like the main point with that is that if you're going to pay the same tax rate anyway, you don't need to go ahead and do this extra strategy. You can just take the distributions from the IRA and then utilize the assets however you see fit.
You could leave money in your retirement plan, pulling out the minimum that you have to, and leave that money to your beneficiaries. They'll pay tax on it, so that's kind of like a tax bomb for them. Or you take as little as you can. As you get to a long-term care at 95 years old, some of those deductions can be offset by the income you're pulling out. So why pull it out? Because I've got the same problem. I have to do RMDs next year. I'm not retiring. And I've got Social Security and and so I have to hire more people. Because I'd rather pay them than the IRS, right? And then go on vacation more. So, but You could leave it in, pull out the minimum and consider it your long-term care plan, self-funded and deduct some of the things. Or leave it to your lowest income beneficiary because their taxes won't be quite as high.
Mhm.
Or the beneficiary you don't like and leave it all to that person.
Exactly. There you go. Yeah. Yes, from the creation of the Roth and yeah, and
And it sits there for 5 years. And then you can put, 50,000.
Is it-
I think.
is it from the creation or is it from the addition of each bit of principal?
So I think it's creation.
Okay. All right. Yeah, okay.
Yeah, if why would you do a Roth, then you're over 59 and a half or over 70 and you want the money. You wouldn't be able to get it if you had to wait for every contribution. I'm pretty sure it's the account, so.
Just trying to weigh those two, your tax rate not being less, and, like you said, when you start collecting social security, you start getting your RMDs, now my tax rate's gonna be higher,
Right.
so.
Yeah,
That's where I was confused when you contributed to the previous plan, 'cause it's like, oh, yeah, I was making $20,000 a year, and I contributed, So,
Right.
obviously, it's.
Do some real tax planning, and if you were ever gonna, let's say, move to a non-tax state, wait until you get there and then do a conversion. Some people do that too.
Both of you are kind of right.
Okay.
You're right on contributions. You're right on conversions. So the conversions, you need to have a 5-year period also. I'm just reading from Fidelity. Conversion.
Okay, so, you got a Roth and you're gonna you got a regular IRA. Okay, the IRA doesn't matter because it's going to a Roth, right? You're not converting.
Remember, what we're saying is when you convert it, that conversion needs to sit for 5 years.
Okay, but you want to pull it out.
Right, and not have it be a qualified withdrawal.
Yeah.
That's the one. Yep, so,
Now, please.
yeah, so that's like adding on. So if you do yeah, so any contributions is from the beginning of the account and then it's whatever. But then if you do a conversion, the earnings on that conversion have a 5-year clock that you need to run out,
Oh,
from what I can tell here. I'm just,
that's the government's way of not letting you have freedom.
exactly. Correct.
Done 5 years.
Right. Essentially, you'll get charged like a penalty, or it won't be considered a qualified withdrawal from the Roth until that 5-year clock runs out for that portion of the Roth. The rest of it's fine, but the conversion amount needs to sit for the 5 years. Yeah, it gets very complicated very quickly.
I won't go into college.
There you go. Okay.
You find. That is like you'll get sent out. Yeah, you pull it out within 5 years, it's gone.
Yeah, exactly. Okay, so we'll just run through a couple real estate things that we'll talk about. So obviously on that personal residence, loan points on the first mortgage will be a nice little deduction you can get. Mortgage interest is deductible for most homeowners on the first $750,000 of home acquisition mortgage. That's not like taking out a refinance or like taking out a home equity loan and any of that fun stuff. It's just buying the house, first $750,000, all that interest is going to be deductible. Exactly. Yeah. Yeah. So it's the same across the board. Then you've got your property taxes up to and are deductible up to certain limits. So in California, that's your SALT tax, state and local taxes that you get up to $10,000 of a deduction. And above that, good luck. And then you've got improvements. So if you do improvements, not maintenance, you're not fixing stuff, you're actually making it better, that can increase the basis in your home as well. Obviously, you're spending after-tax dollars into the home, but then when you go to sell that home later, make sure you kept track of how much was improvements so that you don't end up in a situation where you did all these improvements, you threw away every receipt, and you go, hold on a second, I put 100 grand into this property. And they go, no, you didn't. You owe taxes on all that money. So just make sure you don't end up in a situation where you pay taxes on money you put in on improvements by just keeping track. Even if you don't have every single little receipt, just make sure you just notate when everything happened. They'll be relatively generous, but they're not just going to take your word for it. So the other thing would be Section 121 capital gain exclusion. This is something that you may not have heard the name of, but you're probably familiar with. If you own a personal residence, assuming that you own it and you've lived there for 2 of the last 5 years in whatever order, it could be the first year and the last year, the first 2 years, the last 2 years, the first in the middle, whatever combination you want. If you've lived in it for 2 of the last 5 and you own the property, you can get a capital gain exclusion per person of $250,000. I buy the house for $250,000. I live there for 2 years. It's worth $500,000. I sell it. No capital gains, completely excluded. And then if you're married, you get an additional $250,000 stacked on top of that. So you get a lot of benefits for being married and owning a house together. Yes, you do.
And her daughter owned this one place and she's selling it. She thinks she's gonna get $250,000 capital gain exclusion. Yeah, she will, 250, but not 500, so she thinks she's getting 500.
Oh, is it jointly owned or she owns it?
I think it's jointly owned, I think that's.
Okay, if it's both their residents, possibly 250. If
Yeah,
it's both
jointly
owned, they own 50/50 and it's their residence. That's my guess at that point. If it was just her daughter living with her, she owned it.
No, I think she
Yeah.
put her daughter's name on it and
Okay.
she's gonna sell it now, and she says she's gonna get 250,000, so even though they're not married.
Okay,
So-
if she put her daughter's name on it, the daughter legally owns half of it. It's very possible that you'll find out.
Yeah, so I think that's because of the interests being split.
Yes.
So because the interests in the home are split, each person gets to exempt their certain amount
Yeah.
on each split interest. Okay, that makes sense. So that's like, if you have like joint tenancy with rights of survivorship, it's technically 2 split interests in the same property. So it's like each of you owns half the house. So that exclusion is then going to apply separately to each interest.
It's possible, but if the state or whomever ever wanted to audit you, they might say, okay, let's see her half of the utility bills. Let's see her half of the taxes, and then they could challenge it, and all of a sudden they don't give you that. So see your accountant.
Yeah. Okay. Well, that's something interesting I learned today. Oh, the tax classes are always the ones where I figure out stuff every time we do it.
I used my HSA for stuff. He did an analysis on my tax return that the CPA did, and I did a backdoor Roth, and the CPA called it an IRA contribution. It wasn't. And then I also did a 401k, and he found that they didn't deduct it. Somebody get a.
For how long? For how long did they not put your 401k contributions?
3 years.
Yeah.
My 401k contribution, so I'm getting some huge IRS checks back in August or so,
Yeah.
taking 20.
How much of that check goes to Nash?
Well,
That's what I would love to know. I think that's fair.
yeah, but I did. My chart. Yeah.
Yeah, that's true. That's true. We did get some new software, so that makes me happy
I
enough.
got new software that's like 4,000 a year, so I'm paying for that.
Mhm.
But what I looked at is that when I take money out of my Roth to buy a new tooth or something, not.
Yeah, HSA.
HSA, tax deductible, tax free out. But I found that on that return analysis, he says that, no, the state of California taxes that. So I don't know if I'm gonna use that very often. So those little tiny things you find out, it's nice to have somebody look it up and make sure that you're right, because we make up our own rules or it makes sense, but it may not to the head of auditors.
Yeah. And then the last thing we have on here is you get that step-up in basis also. So if you have somebody that's the beneficiary, transfer on death, goes to a trust, whatever sort of thing you have, somebody inherits it, just like a capital asset, you'll get that step-up in basis and they get to sell it tax-free. So that's also pretty nice. Then you've got your rental properties. So there's kind of 2 different things that you can do in terms of rental properties. You'll have your passive income sort of tax things that you can do against each other. But then if you're like an active real estate professional, as far as I know, there's a lot of really beneficial tax deductions and stuff that you can get there for being actively a real estate investor. But don't get confused. Owning a rental property does not make you an active real estate investor. So just understand that there's some very particular things you have to qualify for in order for that. But if we look at rental properties, we got our loan points at purchase only, mortgage interests, property taxes, insurance premiums. So we're basically looking at a lot of the costs just to continue running the property and make sure that it is actually continuing to do the thing and generate the rental income. And then of course we've got our 1031 exchange. which is really, really great because essentially what that is a like-kind exchange where you can say, all right, I have this rental property and I want to go buy that one over there. But instead of selling the property, paying all the closing costs, and then also paying capital gains taxes on all the gain you've got sitting there, you can say, the IRS will let you say, I'm going to buy that property, and you do it within a certain period of time. You sell this property, move all the cash into the new property, and all the gains just follow you over to the new property. So instead of selling, paying the taxes, and then your basis is this higher number because it's all after tax dollars, your basis in the old property and your gains will just follow you over to the new one, and you get to defer it for a while. And so then you get to go into a new property, hopefully higher value, and just keep going and keep going and keep going, and just keep increasing the value of the property that you own, moving from location to location as you see fit, and deferring those taxes until the ultimate sale. Or then you leave that property to a beneficiary and it gets fully stepped up in value also. So that can be really powerful if you're expecting to go from rental property to rental property to rental property, eventually to bequeathing it to a beneficiary. That can be a ton of capital gains deferral and then ultimately avoidance, or whatever the IRS friendly term for that is. I don't remember. Yeah.
State.
Yeah, I believe it's also state, right?
Well.
Ooh, that's a good question.
If you go California to another state, probably on the federal level. But usually in the state of California, everything's respected. But state to state, I don't know. You'll have to look.
Yeah, that's a good question. That's a good question.
Just looking it up during the commercial break. That one thing is, if you run a business and you're actively involved, remember that thing in the last tax bill, qualified business entity or something? So if you're running a business and you got like the first 20% of your income or something was free, that's what that is. So I own rental properties, but I don't actively manage them, so I don't get to deduct that qualified business entity deduction on the rental properties. It would be nice at that point.
Yeah, it looks like California does actually have a clawback a little bit.
Okay.
So I don't see exactly where it is.
If you have California rentals and you move to another state thinking you don't pay state taxes when you sell them, good luck. Even if you're a resident, you're gonna pay the tax here. And that's good. That's especially for the old pension plans. It used to be if you got a pension and you went to a non-taxable state, you still paid California state tax as well as federal. Then they passed a law saying you can't do that. Now they're trying to put it back in. So if you have civil service, it was kind of hard for you to move to a non-tax state because you still pay California tax.
Yeah.
But you don't pay state tax now, but it's almost fair that you do because, you know, it was civil service. It was where you earned the money, but we'll leave that.
Well, another
Yeah.
thing that isn't fair, step up.
Yeah.
Because the government is not getting any,
Right.
if you leave it to your child.
Right.
That child is not gonna be paying taxes,
Right.
and all
It's-
his taxes are
Yeah.
just.
It's
like
totally bad.
bonds.
We have a social security plan, if somebody would listen, is that when you reach a certain age, you don't get income, you just get tax credits that encourage you to sell your properties, reduce the tax, but you don't get the stepped up basis and everything. And there's all kinds of things that we've been designed to save the world, but,
And
is backwards.
You decided and you're listening.
nobody, we sent out emails all, our social security plan is lower income people get a credit card, a debit card, they go to the stores, they get a massive deduction. Middle income people contribute to social security and increase your income, but when you die, it stays. And then the higher level people that paid into social security on all the income get just tax credits. They don't get any money and they're encouraged to turn money over and sell businesses. And
That makes so much sense. I wish I had
It's on our
some
website.
powers to put that into play.
Well, you wouldn't get the tax credits until you're like 75 years old, so we're hoping you'll die and we tax you, you know, we gotta. This is for, this is for like the Elon Musk and people like that you may not like.
He died, yeah.
So he would only get credits if he would pay a massive amount in and he probably would never see it, so.
Yeah.
anyway, so-
Yes.
Only one exchange and they keep going higher and higher.
Mhm.
Then eventually you get tired of doing this anymore. Then how do you get out of it without paying tax on it?
You can move in.
Move in.
Yeah, you could just move into the property as long as there's some like tail end requirement to make sure it's a 1031. But then after it's been a rental property for a certain amount of time, you could just move in and just live there. And then, here's the best part about that, you stay for the next 2 of 5 years, and then you get the $250,000 exclusion, and now $250,000 of gains is gone.
And the stepped up, and the depreciation allowance, we found you didn't pay tax. So if you depreciated rentals, then you moved in and declared it a home for so many years, and you sold it, then you dealt with whatever gains that you have, possibly cost plus 250 or 500, but you didn't get a clawback of the depreciation.
Really, there's no recapture?
No, that's what I found. You can look it up and do a little.
That's hard for me to believe, but if that's true, that's pretty awesome.
I couldn't find it, maybe you can, but
Yeah.
don't do anything without seeing your accountant.
Exactly. CPA, please.
Now, some
Jeez.
people will sell it and transfer the funds to some real estate limited partnership where it's a 1031, but then now you're invested with a bunch of people and general partners who might not see you're interested for you, and we've seen partnerships go bankrupt,
Yeah.
so I wouldn't do that.
Yeah, those have gotten a lot more popular lately, and there's a lot of bigger companies, like Invesco is one of the big companies. They have a REIT for that, real estate investment trust, and you could do things where you would do this like 1031 exchange to a Delaware state trust, and then sometimes they'd let you do a 721 exchange into a real estate investment trust, which is super diversified. That's complicated stuff that I was researching for a while, but there's a lot of stuff out there, a lot of new things that you can do. But the idea there is that you get into a pool with other people, diversify the properties, so you kind of lower your individual property risk. Then you hold shares of a partnership rather than just one giant piece of real estate. Then you could slowly unwind by selling little bits of the shares over time. Now, obviously, there's management risk with limited partnerships like that, so that can be kind of a lot. But it's just a strategy that's becoming more and more popular that might be worth looking into if you've got a ton of real estate. If you're just sitting on a couple properties or 1 or 2, I wouldn't get too fancy about it. You can figure out a lot of stuff on your own.
But that's mainly so you don't have to manage it. Once it's a real estate investment trust, any shares you sell, you'll still have your depreciated.
Yeah, so that'll still be fully taxable and all that kind of stuff, but it allows you to sell smaller bits at a time
And not manage.
or gift the annual exclusion away.
That's better. Yeah.
So that might be a little bit better, is if you're able to gift the amount every year that you don't get any gift tax on. That we're getting advanced there, but cool stuff to think about. Anyway.
We never argue, we just debate.
Yeah, exactly.
Faster on the computer than I am, so I.
Yeah, you give me 30 seconds and I'll find it. So just a quick reminder, I know we beat this horse to death over and over, just beat a dead horse, but joint tenancy versus community property, just remember, joint tenancy with rights of survivorship only gets a step up on the half or the portion of the person who died, and it's available to all types of relationships. Community property is only for married couples, but you get a step up on the entirety of the account on the death of a single spouse. We just like to remind people about that because it's super, super easy to re-register and really great thing to get. Now, the bottom line, ultimately tax efficiency is the wrap up after everything else to make sure that your plan is working as best it can. Sure, it leads into estate planning and it works with investment planning as well, but really at the end of the day, those things are the most important. To make sure your financial planning is on track, to make sure your estate planning is on track, and your investment selection is appropriate. So those should stay your primary focus, with tax planning as an added layer of scrutiny. It's like you're doing all of those other things and then you're taking tax efficiency and just it influences your individual choices a little bit. This is not the primary thing that you should do for your planning. This is the secondary level that helps make everything else efficient and optimize those returns. So don't be so aggressive on tax minimization that you reduce the effectiveness of your portfolio. Consult your IRS website and your tax professional for accurate and specific information regarding tax law and planning. And now if you've got any questions before we got to wrap up for today, I would invite those.